Volatility in the markets is on the rise after the latest forecasts from the RBA, mixed jobs, wages and business confidence data locally, speculation about US tax reform and sharp movements in the price of oil. A quick update on our forecasts as year-end approaches. Let's start with some good news. Stock markets aren't just rising overseas, including Japan hitting a 25-year high last week, but they've broken higher locally as well, with our ASX 200 briefly through 6,000 to a post-GFC high. Having been lagging the US and most major indices for some time, we seem to be bridging the gap, especially when looking at the accumulation index, which includes dividends. With plenty of talk here that property may be much less buoyant than the last decade after macroprudential policy imposed on Australian banks, stocks may be the preferred asset class, especially as interest rates are likely to only rise slowly from here. And speaking of rising interest rates, we've been talking for some time about when the RBA will kick off its long-awaited tightening cycle, and that seems to have been pushed back a little further now, maybe not until late 2018, based on the latest RBA forecasts for inflation, which by their own admission is below the target 2 to 3% band, and not looking likely to move back above 2% for some time yet. Inflation isn't the only reason to adjust interest rates, but this benign outlook does mean the RBA can take their time. Were it not for this and the weak wages growth and retail sales numbers, we would normally suggest that rates would be going up very soon, especially with global growth rebounding. But as the chart shows, the yield curve has flattened, and some are even calling for no changes to rates at all next year. We'll stick with a prediction of rates to rise around August 2018, which would be exactly 2 years after they were cut to this record low of 1.5%, based on ongoing strength in the jobs market, inflation to pick up as the oil price rises, the need to curb household debt, and strong business conditions. The latest NAB business survey showed business conditions hit a record high of 21.1, and while business confidence wasn't quite so strong, it is still above the long-run average. So low interest rates are helping business profitability, and as the Reserve Bank commented last week, non-mining business investment seems to have turned higher, as it needs to post the mining investment boom. Offshore conditions are also favourable, despite some volatility coming through uncertainty on the timing of US tax cuts, and the latest rise in oil prices augurs well for LNG and other key export markets. The latest Chinese data has been acceptable, while not stellar, and meanwhile, the Aussie dollar has obediently fallen to near the bottom end of its recent 75 to 81 cent range, a good outcome for exports and local tourism. And finally, the jobs figures here remain the most compelling reason to be cautiously optimistic about the Australian economy, with unemployment down to 5.4%, and looking at the last 12 months, an increase of 376,000 jobs, 340,000 of which are full-time. And so despite the lack of wages growth, jobs growth is persistent. However, strangely, the market seems to be focusing on low inflation as a consequence of low wages, interpreting this as a negative because it promises to defer RBA rate hikes. Whereas we would argue that low interest rates are a luxury the RBA can only afford when inflation is low. And so we can keep that luxury for a little longer now. And that's the market update from Bendigo Bank.